Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Brian Curtis along with Doug Krisner. Join us each day for the stories making news and moving markets in the Asia Pacific. You can subscribe to the show anywhere you get your podcasts and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
So here in the States today, we had those U.S.-listed shares in JD.com rallying by around 16%. Several factors were at play, not the least of which a $3 billion stock buyback plan. JD reported a modest beat on both revenue and profit. And let's take a closer look now with our own Catherine Lim, Bloomberg Intelligence Senior Analyst on Asia Consumer and Tech, joining us from our studios in Singapore. Catherine, it's always a pleasure. Let's begin on the e-commerce side here. What did you hear from JD that would allow the market to believe that this company has really turned a corner?
Well, the results itself was a little less overwhelming. It's a 2% marginal beat, as you've actually mentioned earlier itself. I think it was more of a relief that the company is giving back cash to its shareholders via a 22% hike in dividends, as well as an extension of their $3 billion share buyback program. Now, just bear in mind that previously they had in place a $3 billion, and now they're going to start another new $3 billion for the next 3 years. So not much of a new news coming out from there, but really I think it is a relief that it's probably sinking into the markets, particularly since we've heard so much about the competition, and the company is going heads on with Alibaba.
Yeah, the competition is fierce for sure. The executives did seem pretty confident about this year, saying that they could take market leadership. And I see in your comments that both the dividend and the buyback shows that you don't really have to worry too much about a cash drain. Is that how sustainable is that kind of feeling?
Well, there are many parts, again, to JD's.com's overall reported numbers. And really, if you look at the numbers itself, we had a 12% drop in the retail profits. That is the e-commerce side of things. And the bump up really came from the logistics side of the business, which is good to have, particularly since, the logistics business will continue to enjoy economies of scale as it actually goes bigger. So you're going to have these two forces coming together, which then I guess what JD.com really is, can lean on the logistics business to help offset, the profit drag coming from the competition. So net, I think, they're in a fairly neutral position. I would say we'll have to see whether they succeed in getting that market share back from Alibaba, and let's not forget PDD and Douyin.
Yeah, Pinduoduo. I mean, so let's talk a little bit about the Chinese consumer, because I'm looking at what really drove a lot of the revenue gains, electronics and home appliances. What does this tell us about the appetite for durable goods in China?
Well, electronics and home appliances, that has always been a strong category for JD.com. They started off in that business, and that had also triggered earlier talks about them, looking to actually acquire Currys in London. So that's that bit of that. And I think, for it, when it comes to electronics and home appliance, let's not forget that there's a lot of price cuttings going on in China right now, with seeing a lot of the subsidies, etc. It's probably going to be less of, there's going to be less of an impact on home appliance, given that we're going to step into Women's Day tomorrow. So it's all about the cosmetic frenzy out there. But price cuts, low price, affordability, that is likely still going to hold in China for the rest of 2024.
Yeah, part of Doug's question about how healthy is the consumer, they actually did say that they felt that consumption recovery would be further strengthened this year. So that's one company. To Doug's question, and if we could sort of put together the earnings from Alibaba and JD and others, if you put it all together, do you feel confident that the consumer will be back this year?
Well, I guess that really depends on your definition of where we are expecting them to go back to. Are we expecting them to do more impulse buying as what we have seen, prior to the COVID? I don't think so. We're facing a more rational shoppers and probably more discerning in their spending. We've also seen that continued trend that, the consumers would like to actually spend more on travel, leisure activities versus, your discretionary goods and, particularly your super high-end luxury. They're just not buying as much as they used to before.
So, Catherine, you were talking a moment ago about price cuts, discounts on electronics and home appliances. I'm thinking that's going to create margin pressure here. Is this something that JD addressed?
Now, that's an interesting point because I think right now in China, you're looking at, the entire supply chain right now, seeing a surplus of, inventories. They are also, manufacturers are getting more operating efficiency and in a position to actually lower costs. And what's happening is that, some of them are passing their margins and profits through to the consumers. So in the case of JD.com, no doubt there is still going to be a drag on their margins, particularly as they try to actually win back more users from Alibaba and PDD via incentives and perks that we continue to actually see on their platform.
Yeah. All right, Catherine, thanks so much. I like that point, Doug, that Catherine made about it depends what consumers go back to because they were spending really crazily over the past. I think I told you before that when I first came here, the Americans and the Europeans were the rich tourists in Asia. Then in the 80s, it became the Japanese for sure. And then after you moved a little bit later on, you had the Chinese. And the Chinese were buying up properties with all cash and spending on luxury goods and lined up outside the Louis Vuitton stores, like 50 to 80 people in line to get in this store. I don't think we're going back to that. Well, again, one of the featured stories this morning on the Bloomberg terminal, China is targeting its 170 million migrant workers to help shore up the economy. And part of that has to do with the hukou system. Joining us now is Shuli Ren, Bloomberg Opinion Columnist. The only problem with this, Shuli, is that reforming the hukou system is a little bit about freedom and giving workers and people a little more access to go where they want and to still collect their benefits. Do you believe that this is something that can make a measurable impact on the Chinese economy, and can it happen anytime soon?
I think the migrant workers have had a really, really tough time in the last 4 years, especially during the COVID era, right? And then allowing them to move around more freely, that will help the political stability in the society. I mean, they really had a very tough time.
So if you're talking about things like access to housing and medical care as well as education resources, this is a long-term vision here. I mean, I think the government is trying to target some type of transformation. Am I right in that?
Yes, and let's keep in mind that China's migrant workers have been going to the cities for 3 decades, right? Some of them are already hitting their retirement age, believe it or not. China is getting old. Some of them are in their 60s. And even so, they don't have any retirement money because whatever they have earned, they have sent back to their villages to support their children and grandchildren. And again, the last 4 years have been very tough time. And then everybody in China knows about that, and we read about news articles of interviews of migrant workers saying, I'm in my 60s, I'm still working minimum wage. What am I going to do with the future? So this way, it's just a way to help appease the Chinese society and make people feel a little bit better about the government, if that makes sense. And by the way, the Chinese government is also increasing the pension funds for retirees by a slight amount for the farmers, right?
This is the type of thing that actually a lot of critics have been calling for a long time. It is about freedom, though, as I mentioned earlier. It is about giving people more choice in what they do. And when you think about President Xi Jinping and what his priorities are, it's national security and control and that sort of thing. You wonder if, there's sort of competing ideologies or efforts.
No, I don't necessarily see it that way. I mean, like China has built all these infrastructure, right? Like, what's the use of all this infrastructure and the returns on the asset if you don't let people move about and go about and take the trains and the flights, etc. So I don't see it that way. And also, it helps local governments boost their competitive animal spirit, if I may say. The best cities will attract the best labor supply, and as a result, they can sell more land. So allowing migrant workers to move around more freely, it actually helps boost competition across China.
So to Brian's initial point about the impact that it will have on the overall economy in China, do you have a sense of that? I mean, is it going to be significant in the impact?
I think it's hard to say. I mean, the services sector is a little bit weak, right? Like the government is spending a lot of money on the high-end manufacturing, leaving the services sector behind. So perhaps more freedom of labor movement will boost that naturally without the government spending a lot of money on it.
Sorry to bring up the Orwellian side of it a couple of times in this interview, but that's what we've been dealing with in China, and I know that you understand that better than even we do.
I still think, the government is quite okay with, freedom of movements, right? Like a freedom of expression, perhaps is censored, but not movements.
Yeah, I guess so. Well, it is interesting to think about how quickly this can be implemented. We also know that in terms of the individual traveler schemes, for instance, more people are being allowed to travel to Hong Kong. Do you think that eventually makes a difference for Hong Kong?
So far, it doesn't. And then local news media has reported on that because, I mean, like a lot of the city's residents, they cannot really travel to Hong Kong individually, but they have to do it through a tour group, right? But essentially, they have been coming to Hong Kong individually anyhow, because the tour group will say, okay, let me just design a package with only 2 people. That's a tour, right? So there has been a roundabout way. And this is like not really meaningful, to be honest.
So let me take the other side of the trade, Shuli. What could possibly go wrong with this plan?
The mainland Chinese government's plan or the Hong Kong government?
The mainland plan.
Well, everyone wants to go to the biggest cities like Shanghai and Beijing. And then these cities will be very crowded. And we will see that, the big cities of Shanghai and Beijing will say, okay, too many migrant workers, we have to kick them out. And we are going to see that again from 10 years ago. We had that kind of episodes, right?
Shuli, does rapid urbanization lead to more pollution, in a sense, and hurt the fight against climate change?
I think at least in the biggest cities, like I'm from Shanghai, and if you look at the air quality in Shanghai, it's getting much, much better. Like the government is doing a fairly good job at the environmental protection. And let's be honest, the economy is not so great. There are not so many factories churning out things.
A fairly positive Shuli Ren today. Love it. Thanks very much, Shuli, for joining us here on the program. Shuli Ren, a Bloomberg Opinion Columnist, with us live. Let's take a closer look at markets now. Our guest in studios with us in Hong Kong is Ecaterina Bigos, who's Chief Investment Officer on Core Investments for Asia ex-Japan at AXA Investment Managers. Ecaterina, we have lots of time to talk about China. I just wanted to ask you about Fed Chief Jay Powell and the commentary about interest rates. We know he didn't really say all that much. He didn't rock the boat for sure. Everyone knows that the Fed wants to be careful on this front, but that cuts could be coming. I think everyone also knows that the Fed funds rate that was in place to deal with inflation at more than 8% probably isn't the right level now that you have core inflation down under 3%. So I'm not sure what AXA is projecting, but will we see these cuts coming anytime soon?
Yeah, and I think the stance that Jerome Powell has taken is not a surprise for us. As we drafted our outlook for 2024, and with the rally that we've seen in rates into the year end of 2023, we've said that the market is running ahead of itself. So the rally in rates was overdone. So the expectations were the cuts were priced in for as soon as March, and certainly more than what the Fed dot plot was suggesting. And certainly that was an indication that some market participants thought that the economy, U.S. economy, still has a risk to potentially enter into recession or slowdown. Our view was that the U.S. economy is supported by still strong consumer and with some recovery in investment in 2024, supported by the CHIP and the Inflation Reduction Act, is going to stay more resilient in 2024. So our view was from the beginning of the year that the Fed will have scope to normalize and get reiterated normalize monetary policy in 2024 to be in line to where the growth is for the U.S. At this stage, instead of cutting rates aggressively, which is more applicable for a slowdown growth environment.
Speaking of growth, we've got a target now for the Chinese economy is roughly 5% this year, that coming out of the NPC. What's your takeaway with all the other kind of points that we heard in terms of economic policy or ways to stimulate and try to encourage a little bit more demand? Are you confident now that maybe things are at a point where we can say the bottom is in and we're going to see some kind of recovery going forward, or is it just simply too soon to make that call?
Yeah, I think it's a combination. Making that call is a bit too soon, but certainly the 5% target, it's a bit ambitious, considering that we have less favorable base effects that we had in 2024. I mean, clearly the policymakers are choosing gradualism over kind of speedy measures to support the economy. So we might say the market anticipated or expected to have much more aggressive measures and certainly disappointed to some degree, particularly the fact that it was supply-centric fiscal stimulus. What does it mean is that investment is still staying in focus to lift and grow the economy for 2024, and investment is focused on infrastructure, urban revitalization, and certainly some places like technology development is coming as a top task for 2024. Consumption or the measures directed to consumption were there on the periphery, but somewhat disappointing, considering that consumption is a way to remove some of the slack in the economy that we're seeing, or the excess manufacturing capacity that we see in the economy. So again, nothing surprising, somewhat disappointing, and the measures are ambitious, but it's all now centered around implementation of some of the measures, and certainly down the line, whatever they're going to use the monetary policy as a way to support the economy as well.
You do hear a lot from investors. This is sort of hue and cry that that they don't seem to be too concerned about growth, and that the policymakers at the very top, led by Xi Jinping, are all about self-defense now and national security and self-reliance and all of that. But that's still something as an investor that you can play. So would your message, or should the message be to investors, wake up, this is what they want to do, just go find something that will benefit as a result?
Yeah, and I think the point, we do have to look as often as investors above kind of the headlines, and we look at the direction of travel. And the ambitions for China is certainly to evolve or become more technologically advanced. That's important in terms of upgrading their manufacturing and in terms of productivity growth. So the ambitions for China to become a lot more technologically advanced, I think, is going to support some of the sectors. And I think the focus on that is important. And the emphasis that they put into the current package on that, I think it's something investors need to bear in mind. The other themes that China is, of course, paying attention is likely to benefit is energy transition. And energy transition is a scope for China, but also is a scope for developed economies. And China still holds a large percentage of clean tech production, and also it dominates in terms of processing of commodities or rare metals that are part of EVs and some of the wind turbines. So the point is that we need to look beyond the broader macro story and look at some of the themes that are happening in the economy, some of the drivers that are superior to that. But
the thing is, that's all top down, isn't it? And I think what investors, just to argue against the point I made a few moments ago, is investors, like those internet and e-commerce companies, because that was bottom up. That's what people wanted, not what the policymakers wanted.
Yeah, and it seems that there is certainly a shift. It's happening, or at least an indication that there's a desire for the shift to happen, putting kind of private institutional, private corporations on the same level playing field as the state-owned enterprises. So I think the scope is there, and the desire seems to be, or the messaging seems to be the right message. At the moment, clearly, due to the current macroeconomic environment, the SOEs are doing better. They're perceived as being a lot more quality. The dividend payouts are much higher. So certainly they're benefiting at the moment. But as we look into the second part of the year, with the themes that I talked about, with the drive that I talked about, and with the shift in monetary policy, and you have to account for the fact that China will have a lot more room to move when the Fed moves, that certainly will provide support to the other growth sectors that are existing in China economy. So I would say it's a two-stage process when you look at
But if the focus remains on supply, the risk is in maintaining, I would argue, maintaining overcapacity. You talked about the EV. I mean, clearly that seems to be a case of a lot of overcapacity, and that has kind of a deflationary implication, which is the other trap that China is caught in right now.
Yeah, no, absolutely. This is not one point to say that there is no precedent, a rule book or an economic rule book of gear shift from where China is at the moment in an economic cycle, and certainly in the microeconomic challenges that are also structural. So the overcapacity is an important, and they've on a periphery addressed it to some degree through the trade-in programs. But I would expect as we go down the line, they will do a lot more measures to support the consumer. And one part to consider, again, relating consumer to investment is the consumer confidence is very much related to labor market and is related to property market. So efforts to revive the property market and investment to direct it in the property market, recovering that will certainly create the wealth effect and will bring the consumer confidence and will bring jobs. And I think this is important. So again, we need to look at what is the repercussions of some of those investment measures that China is putting in place.
Ecaterina, thank you so much for joining us here in our studios. We do appreciate it. Ecaterina Bigos, Chief Investment Officer on Core Investments Asia ex-Japan for AXA Investment Managers.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.